Over the month of April, we had various inflation statistics, particularly out the US, that surprised to the upside. If we look at headline inflation and core inflation, which strips out volatile items like food and energy, both statistics surprised to the upside, in line with recent months of inflation surprises. Also, alternatively, if we look at the manufacturing prices paid subcomponent, we see that goods prices is now starting to re-accelerate, and that also surprised to the upside over the month. And this is particularly important because the Fed have articulated that they expect goods inflation to go from negative year-on-year prints to level out at roughly around 0% in previous meetings. However, given the stark re-acceleration that we see in the manufacturing prices paid subcomponent and alternative state data releases, we see that there is upside risk to the inflation outlook because of these statistics. Because inflation statistics have surprised the upside in recent weeks, we see that the one-year break-even inflation rate started to move non-linearly to the upside. However, since then, we've had several Federal Open Market Committee members maintain a very hawkish rhetoric to the market, such that inflation expectations went from an unanchored state to a somewhat more anchored state as the one-year break-even rate moved closer towards the 2% mark. If you look how the federal funds rate path has progressed in recent months, we see that we started off the year with multiple rate cuts priced in the federal funds futures market. However, since then, we've moved from the light blue line in terms of several rate cuts being priced in to the dark blue line in recent months, where a much more shallower cutting cycle is priced into market conditions at this state. In fact, we only see one cut, just above one cut actually, priced into federal fund futures markets at this stage. Another very interesting development over the month was the fact that the Fed decided to ease up on the tapering process. So this is particularly important because they are allowing mortgage-backed securities to naturally mature over time to zero duration assets. So they are keeping the pace unchanged of the runoff there at $35 billion a month. However, if we view US Treasuries, they are now reducing the pace of runoff from $60 billion per month down to $25 billion per month. So over time, on the asset side of the balance sheet, this is expected to primarily consist of just US Treasuries. Elsewhere in emerging markets, we're starting to see that China data is surprising cumulatively to the upside in recent months. This is particularly important because of the fact that China has been in a particularly fragile state in recent years, and the fact that data is now surprising to the upside, in line with ongoing monetary policy support, and the fact that we've ushered into a period of less haphazard policy pronouncements, has likely caused markets to re-rate during the month and to outperform the emerging market index in line with its India counterpart. This is particularly important because there's been many false dawns in China, and the fact that we're starting to see some outperformance in line with better data prospects and ongoing monetary policy support makes us cautiously optimistic on the outlook for China.